Since we are talking beverages, you want to take a look at ABEV. They are a Brazilian beer company. So ABEV. All right, let's take a look. Wow, this is a small cap. Yep. So AMBEV SA, through its subs, engages in the production, distribution, and sale of beer, draft beer, carbonated soft drinks, malt. Okay. So these guys are, wow, they've been around for a long time, over 100 years, like Pepsi, like Coca-Cola, a lot of employees, and they are out of Brazil. When we look at this company, similar to Pepsi, no growth. And we're seeing this in the real, the Brazilian real. So, but we'll look at percentages just to see how the company is doing. Now, when we look at the revenue, no growth. Although the most recent quarter, they had positive growth. They had a string of 3 negative quarters. Last year, 2023, they had negative quarter, negative quarter, negative quarter. It looks like they turned things around. Now they're beginning to grow. In fact, this quarter matches the fourth quarter of 2022, which was a good quarter for them. So things seem to be turning around. That's a positive sign. Let's take a look at other factors. Let's look at their gross margin, and then I'm going to look at their free cash flow, but not on this screen, a different screen. Gross margins, similar to Pepsi, 51% gross margins. I think those are good gross margins. This is a beverage company, so it's not like 5%, which would be like a retailer. This is a good beverage company, 51%. Now, let me take a look at what's nice about this website stock analysis is they convert the statistics they put on here into US dollars. So it makes it easier for me to see what their free cash flow and so forth look like. So free cash flow for the trailing 12 months is $3.37 billion. Okay. They are beginning to grow. They're beverage, stable industry. Now cash, they have lots of cash, 3.85 billion, but only a little bit of debt. Very good. Okay. All right. So most definitely they have enough cash on the balance sheet to pay off debt. So this company would be worth, I would say, about 50 billion, give or take 5 billion. I'm taking 3.4 billion. If you multiply it times 10, you get to 340. If you multiply it times 15, you get to about 51 billion. So let's say it's worth about 51 billion based on the industry, its slow growth rate, and they're a $29 billion market cap company. So this company is discounted based on free cash flows. Free cash flows, if you discount those future free cash flows, it'll probably be about 50 billion in value, but I would probably discount those free cash flows by a higher discount rate since it's out of the US and probably arrive at 40 billion to 50 billion dollars. This company over the past year has really come down in stock price, coming down 35.6%. And it really hasn't done anything over the last 5 years. So both Pepsi and AMBEV, I mean, this is a tough situation. Now you're buying into a company that is discounted. It pays a dividend. That's good. But, you know, am I excited about the industry? No. Do I think the industry is going to be worth a lot more in the future? No, I don't think so. I'd rather pick industries that are more, they're building something that's going to be really worth a lot. A company, for example, Uber has been working. Mercado Libre had a bad day today, but they've had a couple of really good days. Mercado Libre is building something that is really valuable. They're servicing the Latin American economy with e-commerce. That's going to be worth so much. Where these guys have been around for more than 100 years, and I just don't think they're going to be worth much more. Could I see this thing working and maybe giving a 20-40% return over the next 5 years? Definitely. And then that dividend is a little enticing at 6.21%. For a young investor, I would say this is not a good option. Go find the next, NVIDIA. Go find the next Apple. Go find the next Microsoft. Because if you find a couple of those, it's just going to be great. You'll put $10,000 and wake up in 10, 20 years with $100, $200, $300,000. That's what I would want for an investor. That's what I want for me. And companies like these are just a little too slow growing, unattractive, undesirable. They don't have any barrier of entry. It's a beverage, right? So you could buy Coke, Pepsi, or other brands. If it's a beer, geez, there's probably 1,000 different types of beers. So That's my feeling on this company. It is sold off, but it just doesn't fit into my investing criteria. If you look at what I own one supermarket grocery retailer, Kroger, but I own like 6 technology companies. I own 3, 4 different communication services companies. I own Amazon, Mercado Libre, and Alibaba, because I think those companies are really going to change their industries. They're very disruptive. They have barriers of entry. They continue to create more value for the customer, for themselves, for their stockholders. That's the investment I want. So thanks for asking about this, Tomas, and I appreciate you.